Before we start, maybe Alicia, if you could shed a little bit of light on what you're seeing in the market. I mean, Blackstone has made two big acquisitions, both Lease K Customers, Tropical Smoothie, Jersey Mike's for $8 billion. You're on the front lines of this. What are you seeing? How do you think 2025 is going to shape up?
So private equity has already invested in more than 700 brands at either the franchisee or franchisor level or both. And there remains really strong demand for high quality businesses in the franchise sector. That's why Jersey Mike's and Tropical Smoothie both traded at very nice multiples because those are both great businesses where franchisees are making money. They have, industry leading profitability and unit level economics that are attractive and plenty of growth left in the tank. So there's an appetite for that. There aren't a lot of scale businesses that are unaffiliated at this point. Jersey Mike's was sort of one of these holdouts that's gone for a long time without bringing in a PE partner. And there's a lot of other brands that would, I think, like to get some help that are not at that scale yet, but really aren't ready for a PE partner. So we should talk about that today, kind of what it takes to get ready. But I think we're going to see in 2025 continued super active trading for those that are high quality brands. The buyers are out there, but we're also going to see, I think, a lot of retrades this coming year because people who invested prior to the pandemic, they've got to exit those. If they're a traditional PE firm, they've got exits they need to do to return cash to investors. So we're going to see, I think, a lot of retrading coming up.
Yep. And the retrading of a lot of heritage brands that have either unfortunately gone into bankruptcy, emerged from bankruptcy, have been acquired by private equity. That's probably what you're speaking of then too, right?
Well, both brands that need a fresh start and a new set of eyes, but also ones that, have grown. So think about Tropical Smoothie. That's a good example. They've had more than one investor in there. Blackstone's their third big transaction, right? It grew from prior owners twice and retraded, as it continued to get bigger and bigger, to a firm now that's interested in taking it international. So it's not just about, private equity has this reputation for coming in and taking companies out of bankruptcy. It's actually a really small proportion of what they do. Most of them aren't
Right.
turnaround focused. They're more growth and value focused investors. Just look at the numbers and the deals that are being done. That's really where they're spending most of their time. A few specialists like to do turnarounds, but it's a much smaller group.
Yeah, yeah, that makes sense. From a timing perspective as to when to start the process, I'll ask you, Jeff, is it kind of like the best time to plant a tree is 20 years ago or today? I mean, when is the best time?
Yesterday. Um, the worst time to do the two worst situations looking for money is when you really need it,
Yeah,
or when you have a gun at your head and you got to get a deal done, even if you don't need it, because then you're not prepared and you make rash decisions and you don't think it through. And so, one thing that doesn't get talked about enough, and which is why I'm thrilled we're doing this today, is not only when should you start thinking about it, but what's the process look like? How much time should it take? And why does it make sense to start early? And again, that's to avoid the situation where you're trying to get a deal done and you have to take all your key people out of what they're doing to respond to due diligence. And we'll get to that a little bit later. But you want to do this where it's a smooth transition and it's seamless, that you've been thinking about it, you've done your homework, you've staged it, you've got the right advisors, you've got the right team. And when that negotiation starts happening, the due diligence comes in, you're ready, and you look like you're ready because that's going to reflect very well on you to the potential investors. So we named this "How to Get Your House in Order." So I think it's a great analogy.
sure.
And if you're on the phone today, like a week before the holidays, you're obviously thinking about getting something done. So first of all, thanks for being here. Second, as Alicia said, I think next year is going to be a very busy year. And so suppose you were going to put your house on the market. Let's just do this by analogy. Again, timing is everything. Got to think, when's the best time to sell your house? What's the peak market? Well, in the franchise sector right now, it's a pretty peak market. There's a lot of deals being done, retrades being done. Private equity firms are trading down, which means that if they previously had a certain EBITDA level they were looking at, they're now looking a little lower because, as Alicia said, a lot of the top brands have already been invested in. So there aren't that many left, and they got to look a little bit earlier. What are your target investors looking for in your home? I always tell people, a good friend of mine's a big real estate agent. It's like, it's not what you think is great about your home. It's what other people think is great about your home. People who are looking for a new home, what's driving them? Not what do you think is driving them? Again, you got to put yourself in the other person's mindset. Why would a investor be interested in your company? What makes it special? And think differently. Looking at your house, is your infrastructure modernized? You bought your house, what's the septic tank look like? What's your energy system? Is it efficient? What's your plumbing, your fiber optics? The reason why those things are important is because the buyer, if you haven't brought it up to speed, the buyer's going to have to spend that money and they're going to take that cost off of your valuation. Same thing with a franchise company, franchisee or franchisor. They're going to do an intense due diligence we're going to talk about. And if they think that things need to be brought up to speed, they're going to discount the cost of doing that from the eventual price. If you've done some recent renovations to your home, what was the ROI on that? That comes up a lot in these deals. Like, I was with a deal where where the company said, we spent X millions of dollars in technology and we should be getting that back in this deal. But the investor was like, well, what was the result of that X million dollar investment? What was the ROI on it? Because they may see that technology investment as a negative, not a positive, if that technology did not lead to greater sales or better margins. How have you maintained your house? Have you painted it? Do you take care of your roof and gutters? They're going to look at the same thing. How do you maintain your system? Is your software updated? Are your leases all digitized on LeaseKick? These kind of things. And if not, they're going to discount you. So think about it like selling a house. You want to come in and have an inspection of your house, see everything that is not up to speed, up to market. Where do you want to put that money in? Where do you want it? You can't fix everything before you go to market. What are the priority things to fix to make yourself look the best when you do go to market?
Yeah. What would you want to add to that, Alicia, in terms of timing and getting prepared?
So my opinion is you need to maintain a state of readiness at all times as best you can. And I recognize that for emerging brands in particular, it's tough, but you just never know what's going to happen in life. And sometimes you need to be opportunistic and to move when the market is attractive. And if you make sure that you're in as much a state of readiness as possible at all times, then you're going to be able to move on things that you need to do and take advantage of a situation. But also it reduces your stress and makes the process more about what you're looking for rather than responding to requests for information or rushing to get things done. If you just chunk it down and try to get things done every month, every quarter, every year, that helps maintain that best possible look of your business at all times, then that's going to set you up well.
It's a great point. I mean, you have to maintain your system. You never know when that investor is going to call. And if your financials haven't been looked at, if things haven't been looked at in months, you're now catching up and you're not ready, and it's going to affect you in the negotiation.
I hope COVID taught us something. One of the challenges I think that a lot of franchise systems had with the pandemic is they weren't collecting enough information about their franchisees. They didn't know about the leases. They didn't have things organized on LeaseCake. They weren't collecting P&Ls. or they were collecting P&Ls, but they didn't know about cash flow. They weren't certain what sort of debt load their franchisees were facing. So they didn't know how close they were to difficulty with the shutdowns. So all of this hygiene of trying to keep this information fresh and actually looking at what's happening in your franchise system and how healthy your franchisees are at all times is just good franchising. And by the way, it helps make you more valuable when you get around to actually doing a transaction. But you should be doing it anyway because you need to know what's going on in your system, and you can't do that without collecting the information.
And not having the P&Ls of your franchisees is a huge hole. And that's, I mean, that systems, it starts sliding and then you let it slide further and then it's really hard to catch up. Following up on that, COVID also in the restaurant sector, the restaurant industry and the hospitality industry in general have been 3 to 5 years behind the rest of the retail sector in the use of technology. And COVID was a huge wake-up call, because all of a sudden these systems had to be able to use technology to survive. And if they didn't have it, they literally could go bankrupt. The problem was that they just started grabbing what they could as quickly as they could and created what I call Frankensteins, where all the new technology does not talk to each other in a clean infrastructure sort of way. And so now that COVID is over, if you're in the restaurant sector and you adopted new technologies and you haven't stepped back to see what's working and what's not and how to clean that up, this is the time, because that's an expensive venture. It's not expensive if you do it thoughtfully and over time. It's very expensive if a buyer's coming in and says, I've got to do this because I want to integrate them with 2 other systems I already own. That's a big cost.
Yeah, and by the way, you need time for your franchisees to get on board, to adopt it, to prove that it's working and improving their business. If you're midway through a change and your franchisees are not that happy about it, that's not a great time to try to go to market. What kind of feedback are they going to get when they start interviewing franchisees, that buyer? So you've got to really think carefully about your timing. And there's a time to move forward and there's a time to sort of hold back on some of those bigger initiatives if you're plotting for a transaction.
Alicia, you want quickly just jump into franchisee surveys and the need for that?
Oh my gosh, if you're not doing franchisee surveys, what are you doing? I'm not sure not sure how to say that diplomatically.
Yeah.
Don't you want to know what your franchise think about being part of your system?
Right.
You should. Franchisee surveys are an incredibly powerful tool to understand what's really going on in your base and what concerns them, and are a great source of ideas for improving the business. And a buyer will want to see those and will want to they will read every single comment.
Oh,
And if
yeah.
you don't have them, it's a red flag. It means you're not really paying attention to what's going on in your system. And believe me, if in many cases that'll just scuttle it right there and the buyer won't be that interested in moving forward. But if they are interested, they're going to now want to talk to every single franchisee they can because you don't have a survey prepared and ready to go. Whereas if you had one, they might be willing to talk to fewer franchisees, which is a little bit less disruptive of a process.
It exposes you really quickly.
Yeah. So it ties back to timing. I mean, you have to maintain this continuous state of readiness, but you can't expect that, hey, you know what, in 6 months, I think I need to get ready to sell. Let's get our act together. These kinds of things take time. What do you see, kind of best case and worst case, Alicia, for companies? I mean, most people that are in the franchise business usually begin with the end in mind, right? They don't want to just have one location. They want to grow to 2 to 3, create a family legacy, and ultimately exit. But what do you see as a realistic time frame? And it's probably going to be a factor based on how big you are and how many units, but give me your sense of that spectrum.
So it usually takes longer than you expect. If you don't have your books ready to go, for sure, it's going to take longer than you expect because the buyer's going to want to do what's called a quality of earnings to understand how cash moves through the business and your sources of revenue and how important they are, your customer concentration, that sort of thing. But if you're an emerging brand, it can also go faster than you expect, which can be unnerving as well. You can get a call from a PE firm and start talking to them, and 30 or 45 days later be bought out for cash because you're a small brand and they can do that. If you haven't sat with that as a founder and really thought about why you're partnering with private equity, or what's this going to do to you, and do you really want to work for someone else, you could end up really unhappy. You need to think about that stuff ahead of time. If you're a larger brand, I would say minimum 3 to 6 months of due diligence is more typical, but it can go longer. And remember that while you're going through due diligence, you're going to be sort of living with your own pro forma. So don't put a puffery, overly optimistic forecast out there hoping that it will look attractive, because if you don't hit it while you're going through due diligence, you've lost all credibility, and the buyer may just see that as a negative signal and walk altogether. So time kills deals, and you can lose the deal right in the middle of due diligence, right up into the moment the thing is signed. The deal can go sideways.
Yeah. Yeah. Is that what you refer to as a stall out? It might be
I call
different.
that a broken
Broken.
auction.
Right.
But it's a great point, because a lot of these companies are being, the initial valuation will be a multiple of EBITDA, and they'll ask you for your projected, if the deal starts in the middle of the year, they'll ask you, what's your projected revenue for the end of the year, for the full year? And franchisors want to get the highest price, so they'll sometimes do puffery, and they'll look at the prospect list, and they'll be asked to rank it and give it a percentage, and they'll go higher than normal because they want to get the highest, multiple, the highest valuation. And then if some of those deals don't fall down, not only do you lose the support of the investor and they start questioning it, but it's negatively affecting your valuation. And when the LOI comes back and it's retraded, it's because of your performance. So be really realistic. And that also gets into, while you're going through this 3 or 6 month due diligence, you're also running your company. And that's something that you're doing two businesses simultaneously. Your management team is running two businesses simultaneously. They're doing your normal job, their normal job, and they're reacting to all this due diligence that frequently they can't ask other people about, because you've got to keep the transaction very close knit. And if you don't think about that ahead of time, I've seen this happen more frequently than not. Such stressing the system. There's burnout on the diligence, and it negatively affects your operations, your sales, and it can just unravel. And so the sooner you think about this and develop who your team is going to be to work on the deal, and get them thinking about that, to get the system up to speed, so that, as Alicia said, you're maintaining it and not trying to put everything together in a 2 month, 2 months time, while you're also trying to respond to RFPs, et cetera, can really stress the system if you don't think it through.
Yeah. And I think team needs to be thought of much more broadly than just your existing internal management team.
Yep.
What we've seen, I think, relatively successfully, is that you may have a bookkeeper, like from an accounting perspective, is that bookkeeper, do they understand what it would take to do a quality of earnings? Because you need to hire a CPA firm that's got the credibility. So your service providers are also part of your team. Make sure you get them ready, or choose the next one that is kind of on that graduated path, whether it's a CPA firm, whether it's your legal counsel, whether it's your real estate broker, because all of them, they're going to need to be leaned on to avoid burnout, because they need to support this entire story as well. I mean, isn't that what you're referring to, Steve? Sorry, Jeff.
Yeah. Do you need to use when do you bring in outside people? And are your current service providers the right people?
Yeah.
You may have a great accounting firm, but they know nothing about M&A and franchising, and they don't understand what the key metrics are that are being looked for, and they don't. yeah, so they may be fine at putting together your or auditing your statements, but if they don't have real expertise in this area, they may not be the right firm. Or there may be other people in the firm and you need to meet them and feel comfortable with them because they're going to be by your side in the foxhole here. Um, and you really, that's the middle of a transaction is not the time to go cheap. You've got to bring people in who have real expertise and have done this before and are going to be able to foresee things coming down the road.
Yeah.
Yeah, and
So,
who you're actually going to be working with, right? It's
Yeah.
easy to get, well, I'm really impressed with this partner, but who's actually going to be working on my team? If you get traded to the JV team halfway through, you're not going to be happy. In the chat, I saw that there's a question about should firms proactively go get a quality of earnings report done? Jeff, what's your perspective on that?
Uh, if you're a company who has had outsourced CFOs or hasn't had somebody with M&A experience internally on your team, I would say yes. It's important that somebody understands what a QOV process is like. I can tell you 100% of the time, the investor is going to do it. And it's much better if you do it yourself and you see what they're going to see and figure out how to either fix it or at least address it in an intelligent, thoughtful way. Um, because another thing, no investor likes surprises. Worst thing to happen. And when they find something in your financials going through it that just doesn't smell right, if you're not prepared to address it until at that time, again, going back to Alicia's earlier comment, their trust and faith in the deal and in your ability to be a good partner starts dwindling.
yeah.
Yeah, along those same lines, I think your annual audits, at some point you need to think about, do you have the right firm doing your books at the
Right.
close of the year? Because over time you need to move to bigger firms that are respected by private equity buyers and trusted. And, when you start, you might have the local accountant in your town do your books, and that's not going to last very long. You need to think about looking professional, buttoned up, that other experienced eyes have been on your business. That QOE, I do recommend that people get that done ahead of time. It also can protect you against retrading pressure because they're going to go in looking for things that cause them concern or maybe could help them bring down the price of the deal a little bit. And if you've got that and you've anticipated that, either you have time hopefully to fix it or you're armed for that conversation.
For sure.
Um,
Yeah, highly recommend quality of earnings, at least one, even ideally 2 years before, because you need time to get your house in order because
oh
it's
yeah.
beyond just, unit level economics. Uh, you don't want to have surprises. Let's forget about your investor, right? It's like,
Right. And there are some times that if you don't have a high level accountant, you may be given advice that is not correct and that the larger firms don't agree with how things have been done. You're outsourcing technology overseas. How are you treating that on your books? I mean, there are different things. I don't want to get into micromanaging here, but
yeah,
there are some key things that can be interpreted differently. You want someone who's done it and knows how the larger accounting firms are going to view it, because that's probably who the investor is using.
yeah, yeah,
Um, can I just switch under while we're talking about outside?
yeah.
So internally, David Barr always he speaks at emerging conferences, and he always has a line that I watch the room to see the mouths drop. Um, and he talks to emerging franchisors and he says, listen, when you started your company, you brought the best people that you could, friends of yours, whatever, and you got the company up to a certain stage. But the people you have, they may be really good and really good at what they did, but they're not the ones to take you to the next level. And he said, if you're an emerging franchisor and when you go back to your office, look around your office, 30 to 50% of those people won't be there in 5 years. Or if they're there, they're doing different roles within your company. And so that's also something to start think about if you are looking to grow and looking to bring in outside equity. Do you have the right people in the company if when that money comes in to execute and meet the numbers? And if not, is there another place for them within the company because they've got experience, they've got knowledge, they're loyal, but bring in the right person before the transaction? I don't know, Alicia, do you think that you should hire before the deal, or how do you view that?
I think it depends. So private equity, in my experience, backs management teams they believe in.
Yeah.
Because they're not operators. So unless you're selling to an independent sponsor who's going to come in and run the business themselves, they're backing your management team. And one of the biggest problems they have is they like the business, but they don't think the team is the one to get them there. So now the question is, okay, well, now we've got to discount the deal because we've got to go now hire people, and there's risk in that because now they've got to go hire people and they've got to learn the business. So I just talked to a founder earlier this week who's thinking about going to market in the next 2 years, and he's still running the show. He's got some strong directors under him, but they're not the lieutenant to take over the business as he retires and exits. So the question is, well, do you bring somebody in now, or do you wait and whoever's going to buy them is going to bring somebody in? And he's at this inflection point where he's got to figure that out, because for sure that buyer is going to want him to stay on for a while until they can bring somebody in, train them as a lieutenant and feel comfortable that they've got the right person in that role.
Yeah. And then the
But
repercussions for the existing team of lieutenants that he or she may have, what signal does that tell them as PE is starting to evaluate whether they can, do they have the chops? It may not be a good recipe for success long term.
I would argue that talent question is also one to contemplate regarding your franchisees. So franchisees of an emerging brand are very often not the same franchisees in that same brand when it's owned by Rourke or Blackstone. And over time, there is this process that happens where either franchisees are on board with changes that happen to grow the business, some of which are put in place to help grow the business, and some of them may be put in place, frankly, because it makes things more profitable for the PE sponsor. But regardless, change is happening, and it's on an accelerated time frame once PE gets involved, and change is always hard. But now you speed it up, and so now you've got this question of, are the franchisees in this system attractive to a potential buyer? Does the buyer feel like this is a good base upon which to grow the business and get it to the next level? The surveys will tell part of that story, but just like your corporate talent might need to change and evolve over time, as you're thinking about who is the most likely type of buyer for the business at the stage that it's at now and what they're going to need to do to get it to the next level, that is something that buyer is going to look at very hard. Who's in your system, how they're performing, how various cohorts are performing against each other. Are there vast differences in outcomes between franchisees? And do they feel comfortable backing this brand, that they can then accelerate this business?
that's a great point at the variance. Because if you've got a system, a QSR, where 30% are at 700,000 a year, 30% are at 1 million, and 30% are 1.4. Well, maybe you want the people who are really performing to start buying out some of the ones who are underperforming before you go to market. And as a franchisor, you can make that attractive to those top performing franchisees and to the exiting franchisees who weren't performing. And you do it before that information gets to the buyer, and they're to Alicia's point, they're saying, okay, there's some older franchisees in the system just aren't performing, but they're not doing the right things to either get them up in their sales or their margins, or they're not figuring out a way to move them out of the system effectively. And what percentage of your franchisees are multi-unit franchisees? And different investors look at that differently. You need to know where your strengths are, and looking at your strengths, who are the right potential buyers as well.
Yeah, there's a question. It's a little bit back to accounting and finance, so we can answer that portion of it offline. But I think maybe Jeff, what it's asking is any potential valuation differences in multiples between, let's say, the U.S. and the EU. I'll start with you, Jeff. Do you see any transaction differences?
Between U.S. franchisees or franchisors? What?
Franchisors that maybe have a stronger, EU presence and, compare and contrast. Uh,
Okay, well, if it's um, again, if you're a US based franchisor and have expanded internationally,
mhm.
and so you're in the US and you're in the EU, I guess the question is, why are you international? How have you rolled out your program? How are they performing relative to the US? Is that a big part of your growth plan? Um, are these experienced developers? So again, I mean, going back to the tropical smoothie and going overseas, I mean, the Jersey Mike's and going overseas, they had to say, we're looking at international franchisees of competitors to the company, the Blackstone, of companies that we're buying. And we're seeing not only white space in the United States, but we're seeing tremendous white space overseas. But that's also supply chain, it's labor, it's real estate costs. Making a blanket statement there is really hard. I
Yeah, no,
guess that's
that's
what I'm getting.
totally fair. Totally
Yeah.
fair. I mean, at least, do you have any view on that? Because we can certainly connect Benvolio to some of our other partners as well to get into some of the details.
So I think that the Subway transaction is an interesting one to talk about here, comparing it
Sure.
to Jersey Mike's,
Yeah.
right? So Jersey Mike's got almost as much money for Jersey Mike's as Subway got, but for a much smaller system. It's 3,000 units or 3,500 units compared to 36,000
Thousand.
units Subway. So Subway, not that $9.5 billion that's not too shabby, but that represented 11.9 times adjusted EBITDA. So the reason for that difference and why it's lower than what Jersey Mike's got by a lot is because they're going to continue to close thousands of units in the United States. And in fact, when John Chidsey was interviewed about this, and I think September of this year, he said, we wanted to get this deal done and start moving quickly on international before our competitors can get there. So it's going to take time for Firehouse Subs and for Jersey Mike's and others to set up the infrastructure and the supply chain and the brand
Yeah.
awareness in markets. So when you're valuing that business, the trajectory of each of the markets that they're in and what the potential is of those markets then becomes the add up. And that's why, as Jeff said, it's hard to generalize. It's really very specific on where that business is and what the trade-offs are going to be. Right now, Rourke, I think, is depending on a lot of international sales to offset what correction still needs to have in the US market, which is overstored.
Okay. Well, good. So let's transition a little bit to tech stack. I think Jeff, you touched on that. There's a question that came in. What are the key considerations that help me differentiate my brand as the franchisor of choice so I can get, stronger multiples? I mean, how do you start to address the strength of your tech stack and some of the differentiators?
Well, it goes industry to industry. But integration is a key part. But it's also the franchisor, typically most contracts, going back to my legal days, the contracts have the franchisors choosing the technology and they should be testing it out before they roll it out. But how are the franchisees using that technology? Is it making their roles easier? Is it letting them run efficient labor models? Is it letting them use efficient supply? There are inventory supply companies that are fantastic that will go and look at your inventory and they'll do a sweep of the country and they'll find you the lowest pricing. Um, do franchisees think that the systems that you're using are very effective in helping them run their business have those investments in technology either increase sales or increase margins, or hopefully both. So just having a really nice, pretty tech stack and things that are, you know, if you're using Salesforce and your system can't support it, then it's a large expense that your franchisees are not taking the time to learn to implement it and make it effective. So what stage are you at? Are you using technology that is good for now and will survive in the future? What is the main, what CRMs are you using? What do they integrate with? What kind of reporting do they have? What kind of reporting do your franchisees have on their phones? I mean, I know franchisees, I run into them at a conference and they'll pull up their cell phone and show me in real time exactly what their stores are doing, lowest and highest. And, part of it is like, look at my new toy, but it's also, they can see while they're at a conference if something is not happening correctly, and they can analyze the system, and they can reach out to some of the home office to reach out to that franchisee to ask the right questions. So A, does it help the franchisor manage the system effectively? B, has the technology investment actually helped the company against its competitor set? Um, I, I mean, I know companies who are, looking. So what's happened in the last couple of years, and I want to go off the whole technology, but there are sort of roll-up companies that are like an Olo. They're a large company. They've got their fingers into hundreds of thousands of units, and they're now buying other technology that is easily integrated in those systems that create a better outcome for the franchisees using their system. And they've identified what are the tools that every franchisee needs, and they're starting to buy those companies so that at some point there'll be half a dozen companies out there that can really effectively give you the technology for the top 6 or 8 things you need. That's where things are moving. If you're using technologies that are only used at a dozen companies and they don't integrate well, it's going to hurt you down the road. It's going to hurt you in being acquired because it's going to be a messy conversion over to a new system.
Yeah. Yeah.
But that's another hour-long webinar.
Absolutely. Frankenstein systems. Do you come across any, Alicia, in your world of technologies that are Frankenstein? I know, Jeff, you started that term, but I just wanted to get Alicia's perspective.
Yeah, I think that, when you start putting things together with duct tape and you're just trying to solve problems, you're not rolling it out gracefully. You didn't get your franchisee feedback in the first place. Hopefully, you don't have some sort of shadow rebate system that's also upsetting your franchisees. If it's done thoughtfully, then fine. But I think oftentimes you're not really thinking long enough term on this stuff. So let's reverse engineer this a little bit. If a buyer is looking at your business, what are they going to like about how it's being run now that they can get behind? And what can they come in and do differently? And therefore, is their opportunity to add value to the business in a fairly predictable, quantifiable way, right? So if you've got this technology snarl happening, that's not terribly attractive. If you've got a franchisee stall out happening, if there's arbitration and lawsuits and franchisees aren't happy, that's hard to unwind. If you've got a strong system, but you just haven't quite nailed franchise development, that's fixable. If you've got, pretty good franchise development, but you really could use some help in real estate getting units open faster, that's fixable in the time frame that a PE owner has in the business. So you've got to really think about what the opportunities are for a buyer to come in and accelerate the business, where you need help, and is that help attractive help or scary help? I'm not sure how else to put that. There's a lot of scary issues that buyers are going to discount your business pretty heavily if they're present in your business, and a technology snarl is one of those areas you want to try to avoid.
Yeah, there's a term that you probably have heard before, but it's like, don't build the plane as it's heading down the runway.
Yep.
Especially for emerging brands or brands that, hey, we've got a year or two, we're planning very thoughtfully about about private equity and kind of that liquidity event. But if they're not recognizing and doing a really hard look at their own internal systems and identifying what's broken or what needs to be optimized, you just need to ask yourself the simple question, like what's the perfect world that you need to achieve from a technology perspective that will ultimately impact what your valuation is? Because those are the surprises. I think, Alicia, you mentioned getting a technology advisor to look at your tech stack. I don't know if you want to touch on that. And then Jeff, I'm sure you have an opinion.
Yeah, look, there are expert advisors who can help audit and do a diagnostic on where you are versus where you likely need to be to to get the business to a place where you're going to be happy with it, franchisees will be happy with it. And you want to make sure you're bringing in people early enough to give you advice on things like the tech stack, your Q of E, are your books clean? Has an M&A attorney looked at your corporate structure? And
Yes.
have they looked at your cap table and the contracts you might have with the early investors in your concept? Get that stuff done ahead of time.
Um, I'm sorry, I'm just having a painful laugh on that last one. Looking at your cap table and your ability to negotiate with early investors is really key. You want to talk to them early if you think you want to buy them out before. Well, there are lots of things, but you just really need to understand your cap table and your ability to negotiate terms.
Yeah, your minority investors that you're taking money from can scuttle
Yeah.
your deal.
Yeah. Yep.
Wonderful.
Um,
So
we did,
go
we
ahead.
need
Not
to
wonderful, but it's good to know.
going back really quick on the readiness portion. We didn't cover it at the time, but sort of like what needs to be in your data room.
Yes.
Let's talk about that. Yeah.
Oh,
So
data room.
I provided to Taj and Michelle kind of your top 10 must-haves. The list is longer, but at least these top 10, if you could put them in the chat, people can pull them down. This is a good place to start. These are kind of the basics to help you understand the trajectory of your business and your franchisee health. So if you're not at least getting this stuff organized, you're really not ready. So this is an area I recommend you at least um, make this a priority this year or coming into 2025 to start getting this stuff collected and doing something with it, analyze it. For example, look at the units opened by month and go back and see, can you demonstrate that units are ramping faster now than they did 2 years ago? Are you doing anything differently to help franchisees ramp up to profitability faster? If not, that's a great thing to put on your strategic plan for this coming year. Make some changes there. So,
Same store sales, right? I mean, it's
yep.
it's not just unit growth for the sake of unit growth. Are they all making more money than last year at a per unit basis?
Are you
Well,
collecting P&Ls from franchisees? Do they all have the same chart of accounts, or is there some
right.
wonky thing happening where you're going to have to normalize it in the spreadsheet? It's awful. You don't want to be doing that on the fly.
Right. And that's something you want to do way ahead of time. And looking at your FTD, are you saying how long it should take to build, and is that reality in your system? If you're saying that, we give you all the plans and everything else, and you should be open in 6 months from signing a lease, and then during due diligence they find out it's taking 9 and 12 months. Well, why is that happening? And are you misleading your franchisees, or are your internal systems as a franchisor not adequate to help, or are you not training correctly? There's a problem here. It's a red flag. And
Yeah. So here's a question that came across, which is all about communication, right? You mentioned franchisees, Jeff. The question is, how much do we share with our franchisees that we're potentially looking at a PE acquisition? And at what point in time do you share? I mean, there's a lot of kind of ways that you can go into that question.
yeah,
What do you think? What do you think, Alicia?
Talk to
I'll give
cancel.
you, huh?
Talk to cancel. Jeff, take it away.
Talk to counsel.
yeah, it's a really tricky question because first of all, what is your relationship with your franchisees? Um, and and you don't know how that announcement is going to be taken within the system. It could create a panic. It could, if you have a franchisee advisory council of people who are respected in the system, maybe you get some input. Hey, we were contacted by someone want to invest. What do you think? How do you think that would be received by the franchisees? Do you think, where would we put that money, and get some input and make it sort of a hypothetical? But I would, it's you really don't want that cat out of the bag until you're ready and the deal is going to close. And you don't know that deal is going to close until it's closed.
Yeah. Yeah. Well, there's the announcement, and then there's the actual approval for the
Yep.
deal, like the
Yep.
Blackstone deal. I think it's in January, I believe. Looks like everything's green light so far. So
Yeah, at some point you have to stop selling franchises too.
Yeah.
So that's why if you have reasonable certainty that thing's going to close, then you can announce it and then you've disclosed that this is happening and then you can proceed. But if you know a deal is coming, you haven't announced it and you're continuing to sell franchises, you're opening yourself up to some potential difficulty.
And you have to, again, communication. You have to be communicating with the buyer that, they need to feel comfortable when you're telling franchisees as well. And if they say, "Oh, don't tell the franchisees yet," well, maybe they don't want to do the deal, So, you get some feedback there as well.
yeah. So, we talk about the franchisors being sold to private equity, getting prepped at a very high level. The question is, to what extent do multi-unit franchisees have to face this as it relates to potentially an acquisition of another multi-unit operator? Do you kind of follow the same playbook, Alicia, or is it slightly different?
Yeah, you do. It's a very similar playbook. It's just that you don't control their diligence over the franchisor piece, right? So you've got to have your ducks in a row for your multi-unit franchise business, but um, hopefully that again, you want to do this well in advance. You want to be working with your franchisor so that if you're looking to bring on private equity to help you expand, you've got to be approved for growth and they've got to be willing to let that PE buyer in, and not all systems are willing to do that. So you've got to lay that groundwork early. Don't wait until you desperately need capital to go have those conversations with the corporate team.
And if you're looking to buy into another system, make sure it meets the competition clause in your contract.
Yeah.
And some franchisors that we name nameless, but have a couple of letters, are very expansive in what they think is a competitor.
That's a great.
Doesn't just have to be in your small niche. It could be in the whole sector.
Yeah. Wow. Uh, Fantastic. All right. So other questions coming through. Let's see. We talked about timing, I love the analogy of getting your house in order because it's absolutely very literal. Uh, it depends on what part of the country and what time and what's the interest rates. It's a lot of factors, but you have to look at it from what do they wish to acquire out of your brand and where's it going. Maybe one of the things we didn't talk about was how do you come up with how much you want to raise? I know we've got maybe 4 or 5 minutes left before we begin to wrap up, but how do you start to look at that?
Um, you want to start, Alicia? I'll jump in after.
Oh,
I
go
mean,
ahead. You sound like you had a thought. Go ahead.
yeah, it's where do you want to be? I mean, are you selling your whole system? Are you looking for a second bite of the apple? What does it, what is it cost? What is your cost of acquisition of new franchisees? What is the time frame? Um, how quickly do you want to scale? So again, are you looking to sell your company? Because then it's sort of what do you think it's worth? You know what your EBITDA is, you know what the market is, you can get some estimates, and then working backwards, make sure that there aren't big holes in your system that would allow someone to cut the price. But if you're looking for growth capital, and then you may want to grow again, how are you putting that money to use? What's the use of funds? How do you justify, what do you think the ROI of that investment is going to be? And you work backwards. It's like, if you're at 50 units and you think you want to get to 150 units before you sell, what's it going to take to get to 150 units? And what is your investor going to see as an ROI from that investment? And then work backwards.
Yeah, I think working backwards in general is a great lens to take when you're thinking about all this stuff. Another way to look at that is, what is your potential buyer goal going to be? So Jeff talked about the return on investment. There are some funds, they cannot invest in minority equity. They
Right.
have to take control of the company. So it's not, in that sense, it's not about how much you're looking to raise. You've got to decide, are you willing to give up control of the business? And is that trade-off worth it? Are you getting the value for your hard work up to that point that makes sense for you? Or are you going to be working with a partner who can help accelerate the business? And do you feel reasonably certain that you're going to get that second bite of the apple that's worthwhile? Just because you're selling to a private equity firm, if you're giving them a seller's note, don't assume that money is safe. That's not how it works. There's lots of ways for your interest to be subordinated. Got to look at those deal terms and get a good M&A attorney looking at the terms. But if you reverse engineer what that buyer is looking to accomplish, that will help answer some of the question.
Yeah. So, anything keeping you up at night, Jeff, as it relates to 2025 around the corner? Are you excited? Bullish?
I refuse to talk politics online.
Well, I didn't ask the political question. I said,
Well, you asked me what's keeping me up at night,
oh my gosh. Well, I mean, listen, this has been such a lovely, in-depth topic that we will continue the series on. We've done, I guess, around 30-ish, maybe close to 40 different webinars over the course of this year. And it is literally with the credibility and the experience of great leaders like you that touch so many facets of franchising. There's $2 trillion of dry powder, right? That is sitting ready to be deployed. Like franchising, I think, drives what, 3% of GDP. It's an engine of labor. It's an engine of employment. It's an engine of opportunity. So we couldn't be more thankful for allowing us to be included in your worlds, Jeff and Alicia, and we thank you for joining our world as well. Look for us coming up next year is only 2 weeks away. So we will see you next year. We've got a great lineup of new webinars that Michelle has been planning with many of our customers, and this topic will continue to be dug into. Alicia's contact information is there in the chat, and this is her book, Big Money in Franchising. And Jeff, can we share
You
your
can put
contact details?
my email in the chat if you'd like.
Wonderful. And there we go, Jeffrey Kolton. All right, perfect. So if anyone needs any information, we're here at your pleasure. If there's something that we haven't answered, or if there's a connection to many of our partners across this space, CPA firms, law firms, great advisors, we're here only here to help. Thank you so much. Alicia, it was a pleasure.
Thank you.
Thank you. And Jeff, always good to see you.